Have you ever wondered how businesses are valued? It's a fascinating world where numbers meet strategy and dollars are pegged onto dreams. Business valuation is the process of determining the economic worth of a business or company. It's a crucial element in many situations such as mergers and acquisitions, business sales, and capital raising. There are several methods used to value a business, each with its own set of assumptions, strengths, and weaknesses. Some of the commonly used methods include the market approach, the asset-based approach, and the income approach. Today we're going to focus on a specific method under the income approach, the discounted cash flow model, commonly known as the DCF model. This method is particularly popular due to its focus on future cash flows, which are the lifeblood of any business. Now let's dive deeper into one of the most popular methods of valuation, the DCF model. What exactly is the DCF model? If you're asking yourself this, you're not alone. DCF, or discounted cash flow, is a financial model used to determine the value of an investment based on its future cash flows. It's a cornerstone in finance and investing, and understanding it can be a huge asset whether you're a business analyst or just a curious mind. Let's break it down in simpler terms. Imagine you're offered $100 today or $100 a year from now. Most people would take the money now, but why? The reason is the concept of the time value of money. This principle suggests that money available today is worth more than the same amount in the future. Why? Because if you have money today, you can invest it and earn a return, making it worth more in the future. Now let's apply this to the DCF model. The DCF model essentially forecasts how much cash an investment is expected to generate in the future and then discounts those cash flows back to today's value. But how do we discount these future cash flows? Well, we use a discount rate, which is essentially an interest rate that reflects the risk of the cash flows. The higher the risk, the higher the discount rate, and the lower the present value of the future cash flows. So if you're evaluating an investment, you'd forecast its future cash flows, discount those cash flows to their present value using an appropriate discount rate, and then sum up those discounted cash flows. The result is the intrinsic value of the investment. If the intrinsic value is higher than the current market price, the investment could be a good buy, and vice versa. In essence, the DCF model is about understanding how much future cash flows are worth today, given the time value of money and the risk of those cash flows. It's a useful tool for valuing investments, businesses, and more. Understanding the time value of money is key to grasping the DCF model. Remember, $1 today is worth more than $1 tomorrow, and that's the principle at the heart of the DCF model. What are the components of the DCF model? In the world of finance, the DCF model is a bit like a three-legged stool, with each leg representing a key component. Without all three, the model simply won't stand up. So let's look at these three legs in more detail. The first leg is cash flow projections. These are estimates of how much money the business will bring in the future. It's not just about looking at past performance, but about making educated guesses about future growth, market trends, and business strategies. Each projection is a balancing act between optimism and realism, requiring a deep understanding of the business and its industry. Next, we have the discount rate. This is the interest rate used to calculate the present value of future cash flows. It reflects the risk associated with the investment. The higher the risk, the higher the discount rate. It's like a mirror reflecting the level of uncertainty or risk in those cash flow projections. It reminds us that money in the future is worth less than money today, a principle known as the time value of money. The third leg is the terminal value. This is the estimated value of the business at the end of the cash flow projection period. It's a bit like looking into a crystal ball, trying to see what the business might be worth years down the line. It's based on the assumption that the company will continue to generate cash flows indefinitely at a steady growth rate. These three components, cash flow projections, discount rate, and terminal value, are all interconnected. Change one, and it impacts the others. Each one is a piece of the puzzle, and it's only when they all fit together that we get a clear picture of a business's value. So, to sum it up, the DCF model is a tool that allows us to peer into the future, make educated guesses, and then bring those future dollars back to today's values, giving us an idea of what a business might be worth now. These three components form the basis of any DCF analysis. How do we perform a DCF analysis? Well, let's dive right in and break down this complex process into manageable steps. Step 1. Forecasting free cash flows. Free cash flow, or FCF, is the cash that a company has left over after it has paid its operating expenses and capital expenditures. It's the money that could potentially be returned to shareholders. To forecast FCF, we need to make assumptions about a company's future revenue growth, profit margins, and capital expenditures. Let's say, for example, we're looking at a company called TechCo. We estimate that TechCo will achieve a 5% annual revenue growth over the next 5 years, maintain a constant profit margin of 20%, and invest 10% of its revenue each year in capital expenditures. Step 2. Calculating the terminal value. The terminal value represents all future cash flows beyond the forecast period. It's a significant component of the DCF model because it captures the long-term economic value of the company. There are different ways to calculate the terminal value, but one common method is to use the Gordon growth model, which assumes that free cash flows will grow at a constant rate indefinitely. Let's assume a growth rate of 3% for TechCo. Step 3. Discounting the cash flows. The cash flows we've forecasted are future cash flows, and money in the future is worth less than money today because of the time value of money. To account for this, we need to discount the cash flows back to the present. This is done using a discount rate, which is typically the company's weighted average cost of capital, or WACC. For our example, let's assume a WACC of 8% for TechCo. Step 4. Summing the present values. The final step in a DCF analysis is to sum up the present values of the forecasted free cash flows and the terminal value. This gives us the total enterprise value of the company. If we subtract any debt and add any cash the company has, we get the equity value. Dividing this by the number of shares outstanding gives us the intrinsic value per share. If this is higher than the current market price, the stock is considered undervalued, and it might be a good investment. And there you have it. We've just walked through the process of performing a DCF analysis. We've forecasted free cash flows, calculated the terminal value, discounted the cash flows back to the present, and summed up the present values to get the company's intrinsic value. But remember, DCF is not a crystal ball. It's a tool that provides an estimate based on assumptions. It's always important to use a range of scenarios and to consider other valuation methods as well. And that's how you perform a DCF analysis. What are the key points to remember about the DCF model? That's the question we'll be addressing as we wrap up our discussion. To start, let's recall that the discounted cash flow, or DCF model, is a method used in finance to value businesses, investments, and projects. It's based on the principle that the value of a business is equal to the present value of its future cash flows. This model is particularly useful when forecasting long-term financial plans. Now remember that the DCF model is composed of several key components. These include projected cash flows, the discount rate, and the terminal value. Projected cash flows are future cash inflows and outflows that a company expects to receive or pay. The discount rate, on the other hand, is the interest rate used to calculate the present value of future cash flows. And finally, the terminal value is the value of a business beyond the forecast period. We also walked through a step-by-step DCF analysis. This process begins with projecting future cash flows, followed by determining the appropriate discount rate. After that, we calculate the present value of these cash flows and add them together. Lastly, we add the present value of the terminal value to arrive at the total enterprise value. However, like any valuation model, the DCF model has its strengths and limitations. It's a powerful tool because it's based on cash flows, which are hard financial data and less susceptible to manipulation than other financial metrics. Moreover, it takes into account the time value of money. On the flip side, the DCF model is also quite sensitive to the assumptions made in the calculations. Small changes in the projected cash flows or the discount rate can significantly alter the valuation. It also assumes that the business environment and the company's performance will remain stable in the future, which is rarely the case in the real world. Remember, the DCF model is just one of many tools used to value businesses, but it's a powerful one when used correctly.